Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks and passionate investor. Welcome to my YouTube channel. If it's your first time here, we're talking about how to invest with conviction by selecting dividend growth stocks. So please subscribe and you'll get notified for my future video. Today, we are talking about Canadian banks, one of my favorite topics. You may not know that, but I've worked for National Bank for like 13 years or something like that. I've been a private banker there and a certified financial planner. I had a lot of fun working for National Bank, and the time of earnings is always special for me because I just love to look at how Canadian banks have been doing. They are the heart and the soul of the Canadian economy. And if you want to know what's going to happen next, the best way to do it is to look at how banks are doing. If they're doing well, you can expect that the stock market is going to do well and the rest of the economy as well. I'll tell you up front, this quarter didn't include any special tricks or any special events, not too much anyway. Most banks managed to beat earnings per share expectations. They didn't declare any dividend increase. So good news, no dividend cut. Bad news, no Canadian banks have increased their dividend. It's not very surprising considering what's happening on the market right now. They're still very cautious and they don't want to spend money that they may need in the future. Another trend that I've seen this quarter is the common equity tier 1. So the ratio for liquidity that is super important to look at. Throughout the year, it dropped for all banks around 10%, 11%. Now, pretty much all banks have declared a 12 to 13%. What does it tell you? It tells you that Canadian banks are well capitalized. Now, let's hit pause for a second. And when I talk about Canadian banks, I just want to make sure that you follow me. I'm talking about the big five. So we're talking Royal Bank, TD Bank, ScotiaBank, BMO, and CIBC, and I'm also adding National Bank, not just because I've worked for them, but because it's probably the best bank that's outperformed over the past 5 years, 10 years, name it. It has done an incredible job, and they have like several growth vectors. So this is why I included also in this video. There was one thing that surprised me though, how all banks or most banks were able to beat earnings per share expectations. And the truth is, they all published smaller provision for credit losses than the market expected. So in other words, everybody thought, oh, they're going to be those huge provision for credit losses. So basically the bank is telling you, oh, we're going to put this money aside because we think at one point in time a good part of those loans will default. Well, it hasn't been the case. In most cases, it went back to normal, which is kind of surprising, but it's also good news. It's telling us that banks, they're telling basically the worst is behind us and we can move forward, but we're going to look into their loan balance sheet to see how and why they think they will not lose that much money, and then you'll understand the secret behind a good banker. So let's move with, in no particular order, I decided to just put them in the order of publication. So let's start with BMO. What I love about BMO in general is that they're well diversified between classic banking, wealth management, and capital markets. The only downside is most of the time capital markets will be a wild card in their year. Sometimes it's going very well, sometimes it's not doing so well. Well, what we have seen this year at BMO is Canadian personal banking and US personal banking are relatively flat. There's not much growth, a little bit more in the US, but not incredible. And the real growth came from wealth management and BMO capital market, which has a huge year. We're talking double-digit revenue increase, which was very nice. And obviously, for all classic banking activities, the provision for credit losses have weighted on their result throughout the entire year. So let's just forget about this part for now and move towards growth vector. Speaking of which, BMO Wealth also include their insurance segment, but this is not the insurance segment that drove the growth for the last quarter. It was a lot more about assets under management that grew by 2%. So basically, to understand is in wealth management, you are making a fee on how much money you manage for your clients. So it's a fee of like, let's say 1%. Well, as long as the asset grows, you're making more money. So it doesn't matter if it's coming from new money or if the market increase, both will contribute to increase your revenue. This is what happened. We also see another trend across Canada is the interest from retail investors to open brokerage accounts. So we have more brokerage account. It's still a growth vector for them at the same time. So those two factors contributed for growth at wealth management. Moving for capital market, it has been an incredible, great quarter, up 38%, and we're talking about money that has been invested. We're talking about investment banking. So this is why you never know when deals are going to turn out in your favor or against you. And this is why sometimes it's a very good thing to have a good portion of your revenue coming from this segment and some other not so much. The market has been favorable right now for those who are willing to take risk. BMO is part of them, and they have enjoyed a stronger revenue from this part. Now, moving on to their loan portfolio, and then you'll see how and why they didn't decide to go all crazy about provision for credit losses, is that their exposure to vulnerable sectors, about 5% of their portfolio. They also mentioned that they want to get rid of most of their oil and gas loan book. They're moving forward. They don't want to hear about it anymore, and they're trying to just clean up their loan portfolio. But as you can see on this graph, there's not much risk involved. In general, most banks, and you'll see that for the others too, they don't want to lend to hotels and they don't want to lend to restaurants and bars and stuff like that at the beginning. So I'm not surprised right now they don't suffer too much. Most of their loans will be tied to mortgages or larger commercial businesses that has long proof, and they're not cash related business. They have like solid financial statements. And this is another reason why BMO is not too worried about what's coming up next. It's not that it's not going to get ugly. A lot of people will lose money. A lot of bankruptcy will happen, but banks have seen that up front and they don't get into those sectors anyway. So this is why they're not really at risk. The second bank that declared their earnings earlier this week was ScotiaBank. ScotiaBank, obviously known for being the most international bank. Well, you can see on this first chart that it hasn't been a success this year. It's actually, between you and me, they're lagging for the past 5 years and the past 10 years in terms of total return for shareholders. If you look at other banks, it's pretty much the worst one in terms of how much you could make money off it. And one of the reasons is their international branch is either going very well or either going very bad. And everything that is happening right now in South America and Central America, they're not really thriving. Obviously, they have a lot of problem with the pandemic, and their healthcare system is not strong enough to support it. So this all leads to stronger provision for credit losses in those countries for the entire year. It hasn't not been a success. More specifically, this quarter, this is one of the reasons why BNS is lagging behind other banks, is mostly because their provision for credit losses increased by 62% for their international banking. And it's important to understand that what happened with Scotiabank is at the beginning of the pandemic back in April, they were not keen on increasing their provision for credit losses that much at that point, and they kind of came in late once everybody else did. I guess it's just a process of debt management and then looking at their risk. I don't think they did a bad job over there, but they were just not publishing it at the same time as the others. Overall, right now, they're pretty much at the same level as other banks, but the international market is not going to grow as expected. When you look at the GDP, the economic growth forecast for the next 2 years, what you see is it has changed a lot since January. And it's important to understand, economists, they do the best of they can, but they cannot predict everything. And especially when you're trying to predict the economic growth of a country, it's very hard in this situation. So at the beginning of the year, we saw the same chart showing Latin American countries with growth of like 3 to 4%. Now we're down at -9, -11, -5 for Chile. So not doing to be very good. And while they expect stronger growth in 2021 as compared to Canada and the US, If you do the math and you consider the economic contraction in 2020 and then the growth in 2021, industrialized countries like Canada and US will perform better than Latin American countries. Unfortunately, as I mentioned before, it's a lot related to their healthcare system and how the pandemic is affecting those countries. I'm not expecting much growth from it, and I expect Scotiabank next year to still lag behind the Big Five. Now, if you look at their exposure to vulnerable loans, they only have 4%, and that includes their oil and gas loan book. So we're not talking about a big thing. You know, they have for 625 billion in loans, and only 4% of it is at risk. So then again, it's normal that bank don't expect too much they don't expect to lose too much in the process. They're not too worried about the pandemic on that regards, and I think that they'll be able to move forward very easily in 2021. Now let's move to National Bank. National Bank, small regional bank based in Quebec, have this interesting growth perspective with private banking, wealth management, capital markets, very volatile, as I mentioned in my BMO review. And also now, more recently, over the past few years, they have decided to expand internationally, mostly in the US and in Asia, with some good success. And we're going to talk about that in this quarter, but overall, this is what happens. It was pretty much flat, not much to say about personal and commercial banking. Small growth. All earnings growth has been eaten alive by provision for credit loss, pretty much the same story as the others, and the rest of the results were supported by good performance from financial markets, wealth management, and their international segment. For wealth management, we have seen strong sales and good assets under management increase. And as I mentioned before with BMO, and if you have looked at my past video on banks and actually have a complete ranking of my top 6, you can watch that in the video description. If you haven't, you're gonna know what I think about all the banks. But what I told you back then in those videos is all Canadian banks with more diversification towards wealth management or capital markets or insurance businesses, they will do better, because classic banking, it's going to be very hard. Interest rate is super low. The default rate will increase. So it's going to be very difficult to find any kind of growth over there. As of to wealth market, well, you've seen the market as I did. The market is doing relatively well compared to what we would have expected back in March and April, right? A lot of people are interested in investing money and they're seeking for advice. Wealth management is there for them. The most interesting part for National Bank this time was the growth from their US and international division, especially from ABA Bank from Cambodia. They have recently acquired all the shares, so now they're 100% invested in ABA. And they also did the same trick with Credigy. There's a specialty finance firm based in Atlanta in the US. They own already 80% of this business, and now they have increased their exposure to 100%. So now they bought the last 20%. This is an interesting and a little bit more volatile type of business. When you're talking about specialty credit, especially right now, I'm not too sure if it was the best idea ever, because now, yes, Credigy business has been thriving over the past 10 years. Right now, are we getting to the end of the cycle and they're going to get bit? I don't know, but we'll see how it goes. I found it quite interesting, and their investment in Cambodia is paying well at the same time. So overall, good performance for National Bank and no dividend increase, obviously. Let's finish with their exposure to COVID. What I really found interesting in their investor presentation, and I invite you to look at it, is that they mentioned that they were decreasing their exposure to COVID-19 vulnerable businesses and also to the oil and gas, similar to BMO. So we can see that there's a trend over there that bankers, they don't want too much to get involved with oil and gas, and they're trying to manage their portfolio in a way that they don't get too much exposed. Then again, we're talking about 3-4% of exposure for a national bank. It is just normal to not put too much in provision for credit loss in those cases. It's not going to be a big hit for them, while it is going to be a hit for the economy. Another of my favorite bank declared their earnings the same day National Bank did, and it's Royal Bank. Love Royal Bank because of its business model. It is super well diversified, and you can see that this year, while classic banking, commercial and personal and commercial banking didn't do that well, wealth management was done as well. However, interest business, investor and treasury services along with capital markets supported growth. That was good news. And when you look at how the company is diversified, I found it interesting because sometimes we mention ScotiaBank as being one of the most international business, but when you look at Royal Bank, they're not doing so bad, with 40% of their revenue coming outside of Canada. And what is most interesting is the last pie chart, which showing that classic banking is only 37% of their revenue, and a lot of it is coming now from wealth management, capital market, and insurance. This provides a great way for Royal Bank to identify what is growing right now and then put more emphasis into it. Speaking of what's working well, wealth management, RBC focus on asset under management growth. They have now a market share of 16%. So they're number one in high net worth client with their private banking system. Did a very good job. Another place where they did well this quarter is capital markets. They have actually a record result. As I mentioned with BMO, those would have a higher appetite for risk did very well this quarter. Well, it was the case for Royal Bank. We can see that revenue were up double digit, and similar to BMO, global markets and investment banking were highly profitable this quarter. Finally, in terms of exposure, it's pretty much the same thing as we have discussed for the other banks. Small exposure, not too much oil and gas, and then they're feeling pretty comfortable with what they have right now. We should not expect a big catastrophe in 2021 from Royal Bank either. Now, we have two last bank to discuss, but before we jump in, I want to tell you that recently I have hosted one of my best webinar. It's a webinar about payout ratios and understand how they work to make sure that you don't suffer from dividend cuts, that you see them coming, and then you have the opportunity to get rid of your stocks, sell those bad companies in your portfolio before they cut their dividend, before they lose in value. So please, check out the link in the description below. It's a free webinar. It is a recorded one from a live event. When you click on it and you register, you will go directly to the replay. No string attached, 100% free, and I answer questions for more than an hour to all attendees over there. So I think that you're going to enjoy. Now, back to this topic of Canadian banks. Let's move with TD. So as you know, TD is the most American Canadian banks, if I could put it that way. They had a pretty good year. They obviously posted strong earnings because they sold TD Ameritrade, and this kind of modified the entire year and the entire quarter. But what I wanted to highlight over here as well is the common equity tier ratio of 13.1%. Super well capitalized. They're very solid. And when we look at the results, we can see that the sell of TD Ameritrade went from $2.3 billion in their earnings. Earnings were up by 82% for that. If you adjusted, and it's kind of funny because they put in a little small thing, but adjusted EPS is only up by 1%. You can also see here the provision for credit loss that was pretty much in line, which was with what they had last year. So basically what happened here for most Canadian banks in summary is they had huge credit provision for credit loss in the past 2 quarters, but for this quarter they pretty much went back to normal, sometimes slightly higher, but nothing to make a big difference, nothing to tell you that they expect a huge recession or anything. Then again, it's great news for us in general, and I think that moving forward we should see smaller provision for credit loss. Then again, it will be even better news. When you look at Canadian retail, that is a very important segment for TD. It's pretty much flat. Net income is up 3%, revenues are down 2%. Not much to say here. Then again, the classic PCL, the provision for credit loss story, that's pretty much the same story that we see in the US retail, where revenue are down by 8%. Then again, provision for credit loss still important over there, but nothing to worry about. We can see that. So we have pretty much the same story on the US side, but revenue were down by 8%, so it's a little bit more. Loan volume were up by 7%, which is kind of great. But when you think about it, revenue will have a hard time to increase going forward because interest rates are super low. So the only way they can do it is to by making more loans and seeking for more deposits. Going after more loans right now, is it that a good idea? Obviously they want growth, but they want good growth and they want to make sure that they have control over their portfolio. So I'm not expecting a huge increase in loan for next year. I think they're going to be quite cautious about it. When you look at their loan portfolio, they have like pretty much one of the biggest exposure to COVID-19 vulnerable businesses at 6.4 of their total loan portfolio. Again, not the end of the world, but when you look at the others that are more around like 4 or 5%, at 6, it's starting to be a little bit higher. So we might have a surprise down the road from TD. I hope not. I don't think so. It's one of the best managed bank in Canada, but just keep that in mind. Take a look at their provision for credit losses going forward. It may have an impact. And now let's finish with CIBC. CIBC, classic bank, most of it is personal commercial banking. They do a little bit in the US, they do a little bit in wealth management, obviously. They focus on digital right now. Pretty much the same story as the others. What I wanted to show you here, which is quite interesting, is dividend payout ratio adjusted at 60%. So when you think about your dividend, and CIBC is the one offering you the highest yield, and you may think, oh, it's offering the highest yield, maybe I'm in trouble and maybe they would be the one cutting their dividend. Well, I'd say 60% payout ratio, you don't have to worry about it. And CET1 ratio, liquidity ratio at 12%. Then again, very well capitalized. They have plenty of money in bank. You won't have dividend increase this year, but what you can make sure of is that you can enjoy your dividend from those banks. What we see here for personal and commercial banking, obviously it went down, but it's slightly improving compared to the other quarter. Loan balance are up 2%, deposits are up 15%. So business as usual, slow growth, but then again, we're talking about growth. It's better than not talking about it, right? So overall, pretty good quarter for CIBC at the same time. Let's look at their COVID-19 vulnerable businesses. Once again, we don't have a huge exposure here. Their oil and gas loan book is like 2.2% of total loan book, and then they have like 1% in leisure and entertainments, 1% in retail, 1% in auto lending. So overall, not too worried about it. And one thing that I really liked, and I think that this is one of the signal from most banks, and one of the reason why they haven't increased their provision for credit loss is this last chart that has been published by CIBC. This is the number of accommodation from clients that could not afford to pay their loan, and you can see that there was a huge demand back in March, April, and May, and since summertime it has gone to almost zero. So basically, the big wave of potential financial problem happened at the same time as the COVID wave, but right now we don't see that anymore. So all the bad clients kind of like raise their hand right away, kind of show up, and now we can see that all banks are feeling a lot more comfortable. They're still cautious. I would not be surprised if in 2021 we won't have another dividend increase either from all banks. Maybe towards the end of the year, but we're going to have to review this situation quarterly, obviously. But at this point, I think that they're going to sit on the pile of cash, make sure that they have everything under control, that they move their clients toward mobile and toward digital banking. It's actually a very good wake-up call for them, because there were a lot of like smaller financial institutions that were going after the big banks through digital and mobile banking. Now they already know about that. They have been investing in it, but right now it's more important than ever. And I think that they have the mean, they have the liquidity to move forward with that. And this is where their focus should be. I hope that you have enjoyed this video. If you want to know more about what I think about banks in general, then again, right there below in this link description, I have my top 6. I rank each bank and I tell you a little bit more about their business model and how they do. Hope that you have enjoyed this quarterly review of Canadian banks. If you have any question about any of them, or if you want to talk about Laurentian Bank or Canadian Western Bank, leave your question below. I'm all ears, I'm all there, and I hope that you have enjoyed it. And until the next video, stay invested.